Several market indicators can contribute to a bullish sentiment in the stock market. These indicators often reflect positive economic conditions, investor optimism, and favorable market dynamics. Here are some key market indicators that can cause a bullish outlook. Economic growth. Strong economic growth, as measured by indicators like gross domestic product growth rate, consumer spending, business investment, and employment growth, can fuel optimism about corporate earnings and future market performance. Corporate earnings. Positive corporate earnings reports, especially when companies exceed analysts' expectations, can boost investor confidence and drive stock prices higher. Rising earnings often reflect strong business performance and potential future growth. Low interest rates. Low interest rates set by central banks stimulate borrowing, investment, and consumer spending, which can support economic growth and drive stock prices higher. Lower borrowing costs also make equities more attractive relative to other asset classes. Accommodative monetary policy. Central bank policies, such as quantitative easing or interest rate cuts, can increase liquidity in financial markets, lower borrowing costs, and stimulate economic activity, leading to a bullish market sentiment. Favorable economic indicators. Positive data releases on indicators such as retail sales, housing starts, consumer confidence, manufacturing activity, and job creation can signal a healthy economy and contribute to a bullish outlook. Strong market breadth. Bullish market breadth, indicated by a high number of advancing stocks relative to declining stocks, suggests broad-based participation and strength across various sectors of the market. Positive investor sentiment, reflected in surveys, sentiment indices, and market positioning, can create a self-reinforcing cycle of optimism. This optimism drives stock prices higher as investors become more confident about future market prospects. Strong economic growth in major global economies can benefit multinational companies and export-oriented sectors. This growth contributes to higher corporate profits and a bullish market outlook. A stable political environment with favorable policies for businesses and investors can provide confidence and certainty. This stability supports economic growth and bullish market sentiment. Technological innovation. Breakthroughs in technology and innovation can drive productivity gains, business efficiencies, and new market opportunities, fostering optimism about future corporate earnings and stock market performance. While these indicators can contribute to a bullish market sentiment, it's important to recognize that market dynamics are complex and multifaceted, and other factors such as geopolitical events, monetary policy shifts, and unforeseen developments can influence market sentiment and direction. Traders and investors should carefully assess a variety of indicators and factors when making investment decisions. Bearish market. Several market indicators can contribute to a bearish sentiment in the stock market. These indicators often reflect negative economic conditions, investor pessimism, and unfavorable market dynamics. Economic contraction, as indicated by declining gross domestic product, weak consumer spending, business investment, and employment contraction, can raise concerns about recessionary conditions and lead to a bearish market sentiment. Weak corporate earnings. Negative corporate earnings reports, especially when companies miss analysts' expectations or issue downward revisions, can undermine investor confidence and lead to selling pressure on stocks. High interest rates. High interest rates set by central banks can increase borrowing costs, slow down economic activity, and reduce consumer spending and business investment, leading to a bearish outlook for stocks. Tightening monetary policy. Central bank policies such as interest rate hikes or tightening of monetary policy can reduce liquidity in financial markets, increase borrowing costs and dampen economic growth, contributing to a bearish market sentiment. Unfavorable economic indicators. Negative data releases on indicators such as retail sales, housing starts, consumer confidence, manufacturing activity and job losses can signal economic weakness and contribute to a bearish market outlook. Weak market breadth. Bearish market breadth, indicated by a high number of declining stocks relative to advancing stocks, suggests widespread weakness across various sectors of the market and can erode investor confidence. Negative investor sentiment. Pessimistic investor sentiment, reflected in surveys, sentiment indices, and market positioning, can create a downward spiral of selling pressure as investors become more cautious about future market prospects. Global economic slowdown. Weak economic growth in major global economies can weigh on corporate profits, trade volumes, and investor sentiment, contributing to a bearish outlook for stocks. Geopolitical uncertainty. Geopolitical tensions, conflicts, trade disputes, or political instability can increase market uncertainty and risk aversion, leading to selling pressure on stocks and a bearish market sentiment. Technological disruption or innovation. Disruptive technological changes, regulatory challenges, or shifts in consumer preferences can negatively impact traditional industries and businesses, leading to concerns about future earnings and stock market performance. While these indicators can contribute to a bearish market sentiment, it's important to note that market dynamics are complex and multifaceted, and other factors such as policy decisions, market sentiment shifts, and unexpected events can influence market direction. Traders and investors should carefully assess a variety of indicators and factors when making investment decisions.